Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report and whether the market has already priced in Fed rate cuts. Logan, welcome back to the podcast.
Once again, Sarah Wheeler.
Labor
over inflation. Jobs Friday morning, we're talking. The 10-year yield is kind of all over the place. It went lower at first, it spiked up and went back down. So intraday action is pretty wild. I don't know how it's going to close, but we always talked about that 380 level is key. And for that to break lower, it's going to need economic weakness. So jobs weak. So what do we find out? 3 of the 4 labor reports are going down. The big one, the final act, jobless claims, held up pretty well. So the labor market is deteriorating, has been deteriorating for months. The Fed was like, we don't care. Logan was right. We are going to keep financial conditions as tight as possible because we need cover cuts, right? That's kind of how I phrase it. And I think everyone understands that we're at the point to where I think if they cut rates, nobody's going to say anything, right? The last 3 months have deteriorated. Now, you and I have been talking about residential construction workers for many months now. I've gone on CNBC and talked about it. With the revisions and everything in place, that sector has gone nowhere for months now. In fact, we actually had one of the months were actually negative, not by a lot, but negative. This last report had manufacturing data lose jobs right now. I know Intel is not even thinking about building their plant now in Ohio because of too much capacity, not enough demand. So when the Fed says they're keeping policy tight, it's investments, right? Do you invest your next plant into creating capacity because demand warrants it? And manufacturing and residential construction workers tend to lose their jobs first. This is why we want to focus on this side of it. And I think they achieved what they wanted. I think nobody's going to question if they cut rates now, because the whole plan since 2022, when they spiked the Fed's eggnog, was to go after the labor supply. They've used this term 645 times over the last 2 years. We must attack the labor supply, right? Because job growth slowing down, wage growth slowing down, that was the whole intention, and they've completed it. I mean, we're sitting here today. There's no rate cuts. Thankfully, the bond market got ahead of them. And this is where we are. We're at another stage of the cycle, and that's how we should pretty much look at it.
Okay, so what everyone in our industry cares about, right? Mortgage folks, real estate folks. What does this mean for the rate cut, the first rate cut?
So rate cuts, you'll get a quarter, possibly now 50 basis points. But remember, rate cuts don't matter. The 10-year yield matters. Why, Sarah? What was that slow dance? Right? We don't want to focus on rate cuts. We want to focus on the labor data. We have a near 2% move lower in mortgage rates from the recent peak with 0 rate cuts. Nothing. That's a massive move, right? So what rate cuts can do going out in the future is make the spreads better. So I want to get people off of the Fed rate cuts, focusing on that, because a lot of people think, well, rates will go down. The rates have already gone down. We've always said the bond market gets ahead of the Fed. They try to do it twice. We brought out the U.S. Bank event. Was it a few months ago? You and I went to that, and that video clip of me saying, for the first time, I feel really confident now that the next move lower in rates has a little bit more validity. That's when the 10-year yield and mortgage rates are higher. Now we are here today below the 380 level, and the labor market is clearly deteriorating in front of everyone. So for everyone in the industry, the slow dance was created for all of you to teach your clients and everything that rates do not wait for the Fed. They will get ahead of the Fed. And they will continue to get ahead of the Fed, because if the labor data, let's assume hypothetical, so everyone could talk to their clients, let's just assume the next 3 months, jobless claims go up to 323,000. I'm not saying it will, but it's hypothetical. Do we think the 10-year yield goes up to kind of meet the Fed funds rate? No, it'll go down. So paper, rock, scissors, labor data. The reason why the 10-year yield is below 380 is that the labor market has been deteriorating. So everyone in the real estate and mortgage industry, get your clients off of the rate cut story. Teach them the slow dance, because right now we've had a near 2% move with zero rate cuts.
Okay, well, then talk about the spreads for a minute. So the rate cuts do impact things. So talk about what we're looking for.
So where I think the rate cuts and a more dovish Fed can help is actually the spreads. Um, Again, it's policy choice, right? It's economic policy choice to be this tight, right? We're in September of 2024. There's no rate cuts. The spreads are still historically bad, and they need the housing market back to prevent construction workers. So if they really cared about Sarah, could you imagine if I had Bostic or Daly or Kashkari? Could you imagine a one-on-one Kashkari in front of it's like the movie Mummy. I'm the Medjai. He's the mummy character. He looks like the mummy actor. I could be the Medjai guy, and it would be a great economic debate. What we've seen over the last 5-6 decades is that when Fed policy becomes more dovish, the spreads get better. Now, of course, the spreads, when rates go up a lot, the value of that, to the mortgage-backed security market is less. So it's riskier to do business. This is why the spreads get higher at times and go better. But if we're now in a full blown, we're going lower, this is where the Fed rate cuts can help the spreads, right? I think the debate I had last year with people is that people said, well, hey, listen, if the economy is going into recession, the spreads can go higher. Some people even talked about the 1970s getting back to 5 to 6% spreads, which would, mortgage rates could go 3% higher. This is how you get the 11 to 12% mortgage rate calls. It's like, okay, we're at a different point of the cycle now. Yeah. That's probably not going to occur. We've been at elevated levels. So I think with rate cuts, with a more dovish Fed talk, the spreads can get better, right? As we're slowly moving down now with rates, and we take that next move, we've had that 2% move, we take that next move lower and we stay there. Over time, the spreads should get better. Does it get to 1.6 to 1.8 anytime soon? Probably not likely, but anything helps, because right. We have seen actually the data get better, even though people still can't read the purchase application data correctly. We have seen a little bit of better data in the mortgage MBA purchase apps. We've had the first 13 weeks of positive data. It's not a lot, but it's an improvement. Imagine if mortgage rates go sub 6%, because the new home sales sector has been able to grow sales. They've been able to grow sales in a sub 6% mortgage market world. So we need to test that model with the existing. So I think rate cuts and a dovish Fed helps on that part. So that is important. But if you had waited for the Fed to cut rates for mortgage rates, you already missed a near 2% move lower. So hopefully by now people can understand. That's the reason I did the slow dance, is that I'm trying to get everyone to imagine me slow dancing with you, guy or girl. Okay. But it's the economic data that right. moves this, right? Because if we're waiting for rate cuts or rate hikes, it's just not going to work, right? It's not going to work that way. So rate cuts would be positive, a more dovish Fed will be positive for spreads and everything. But it's the labor data that runs the show now.
I think this is a difficult, because consumers just focus on one thing, right? They're looking at the rate. They may not be thinking about affordability overall. And they've been very focused on this, in a normal cycle. I don't know that consumers are like, what is the Fed going to do? Right now, everybody's clients is following this, I would think, if they're thinking about buying.
That's why we need to have a national commercial of me doing a slow dance. And the 10-year yield, and then just basically show since 1971 what's been going on here, right? The Fed funds rate matches, but in a sense it's behind. And if you're an LO or a realtor, get on board with this, because rates have been falling now for some time. Zero. No rate cuts have happened. So now we have to go to the next stage. And again, everybody has their own economic view. Take now that we're a little bit under 380, to make another move lower, you're going to need weakness in data. I always say that jobless claims can take you there, right? Because then we say goodbye to Hodor. We say it's hello Gandalf, homie, what's up? the actor said he'd do another Gandalf role, but they should like ask him really quick because he's pretty old. He could die anytime. So,
Oh my
um,
gosh.
yeah. So if now back then in 2023, I thought, okay, if we really break under 3.37 and take a like, this has to be a recession, right? So I just don't see it in the labor data. So we're gonna hold the line, right? You shall not pass. So we're not there yet to test that. But again, if jobless claims 323, 323,000, then yeah, you can get that next leg lower, but not quite there yet. Not yet. But as we can see, it's deteriorating. And the Fed is starting to lose control of the narrative because some of their talking points now, they're stiffs, man. They're not very clever. And they sound awkward to people now because now it's like the public the public sees this now and they go, wait, job growth is slowing down. I don't know what's going, so if I was a PR advisor to them, just turn with it and start talking. Nobody's talking about zero interest rate policy or QE or whatever, but
Right.
but you are now in the framework that if something breaks on you, it's on you now. And everybody says you're old and slow to the upside, to the downside. So think about it. Get in a team huddle. See, this is what I would do. I'd get all the Fed members in a team huddle, right? And we would all just, okay, here's the game plan, guys. Don't listen to Neil Kashkari, but somebody tape his mouth up. He's not talking anymore. Okay, Daily, no, get away. Where's Bowman? Bowman, a reacceleration of inflation. No. Okay, we're gonna make sure to keep the economy going because residential construction workers are not going anywhere. Manufacturing just lost. Those are the last two keys that happen in every single economic cycle. So we want to focus on that because, again, there's so much data out there that it's not like they are the God Almighty and only they know. Everyone's out there with a data line. So we just focus on that. And again, we're just at a different stage of the economic cycle, like we've talked about, and then we take it one day at a time. But this was always about the labor market. Rock, smashing scissors.
No, I love that. Okay, so we had other data come in this week. What do you make of that?
No, I mean the job openings data. Again, we talked about this last time. We're heading toward that 7 million, but the internals of the job openings data is weaker, right? The hires are now falling below where they were in the 2008 recession. So the layoffs haven't happened. It's all about layoffs now. If we just had to do on hiring, the rate of growth of hiring slowing down would be totally problematic. So, yeah, the job openings data was weak. The ADP report was weak, but again, I just think that's like the annoying brother at a party that everyone wants to leave. But the jobless claims data hasn't broken yet. So we're at this stage where now we focus on the layoff data, and in that context, and also especially after the negative revision, we've always had negative and positive revisions. I encourage everyone, I know nobody's going to do this, go back and look at the last 30 years of positive and negative revisions and how it always happens. We are now, the 12-month moving average is close. I mean, the labor market technically is still beating my estimates on a 12-month average, but if I shorten the duration of the jobs data, it's getting weaker. So there's no cover kind of here anymore. So land the plane. And they need the housing market back. So why? Because residential construction workers, Home Depot warned, Lowe's warned, 5-unit permits are recession level, single family permits. It was a positive probably in their minds that the new home sales beat. We keep that going, but they cannot allow yields to back up because of some stupid Fed statement that comes up. Oh, God, we're not near 2%. I just, so it's just land the plane. Just come on. So I'm telling you, Sarah, if I got them in a team huddle, this would happen. So I think the interesting point is Powell left for a bigger opening for a 50 basis rate cut than his counterparts. So the counterparts are kind of all over the place. So we'll watch. We still got some inflation data and everything, but again, jobless claims is the key, guys. If this starts to break, there's nowhere else to hide. Job growth has been slowing down. We see deterioration in the key sectors. That breaks on them. That means they're already too late. So get ahead of the curve, right?
Right.
Get ahead of the curve.
So, I mean, you say that, the market's already priced in a rate cut, but it hasn't priced in all the rate cuts. So, at what point do the Fed rate cuts start to matter?
I actually think they've priced in what we're thinking of a near a neutral policy would be. So of course my take has been I've been very simple on this. I wouldn't have done the last 6 rate hikes.
Right.
So I think if the Fed could do a magic wand thing, they would take the Fed funds rate to 4%. Right. And that would be neutral policy. See, we're only talking about how do we get to neutral policy. We're not talking about accommodative, right? Because if you have a job loss recession, then you have to say to the public, we believe neutral policy in a job loss recession is okay. Oh, Sarah, if that conversation happens, we are going to light them up. Oh my God, it's going to be like wider. Okay, Corral. Here we go. By the way, there was an absolutely lovely documentary about Wyatt Earp on Netflix. That was absolutely amazing. In any case, that'll be the interesting discussion going out. When do they switch the discussion from we want to get, see, right now, all they're talking about is we're going to take our time to get to neutral policy. They're not talking about accommodative. Like, this is why I say that they haven't pivoted. If they had already cut 3 times, they're still restrictive on their own model. And we have to go with their own model. None of us, it doesn't matter what any of us think. It's their own model. They're doing it. So that is the next great debate about, is neutral Fed policy warranted if there is a job loss recession and we're losing jobs. So again, some people say they're behind the curve. I always say this was always their game plan since 2022, right? I've got that annoying Twitter post where I'm just talking about, the Fed won't pivot, so that'll be the next, we haven't crossed that bridge yet, but do they move from a neutral discussion to an accommodative? But you get that going, you got sub 5% mortgage rates easily, right? You got the possibility of even the Fed purchasing mortgage-backed securities at that point. At that point, they've lost the whole narrative and everyone is pointing at them. Hey, wait a second, you said, but we're not there yet, but it's something to think about down the line.
Well, let's pivot just a little bit, our own baby pivot here.
Did you just say pivot, baby pivot? Oh, look at you, Wheeler.
I did.
Wheeler.
I don't
Clever
have your
girl.
pop culture references. I don't have those down. I didn't watch Game of Thrones, so you had to tell me who Hodor was.
Hodor.
Hodor. Hold the door was. So anyway, but yes, let's pivot over to another part of the things that we look at, and that's the tracker data, right? So you've been looking at inventory. Home prices are something that people are really thinking about, because as you have rates fall, you're going to have demand pickup. What does that do to inventory? What does that do to home prices? So lay it all out here for us, Logan.
So the tracker article, again, is by the time this podcast comes out, we'll get another one. It'll have the Labor Day holiday stuff in it. So, always be mindful of Labor Day or holidays wreck all economic data for housing. The growth rate of inventory has slowed as mortgage rates have gone below 7%. That's been the case. I have not been able to hit my model once. Now this year, so I've talked about this, if mortgage rates are 7.25 and above, we should grow between 11 to 17,000. That would be normal for me.
That's inventory per week.
That's inventory. That's the weekly active inventory in our data line. That's happened 6 times this year. It's never gone above 17,000. Sometimes it's been below 11. But that looks normal, healthy again. I'm very happy. I'm like, we're 2020 to 2023 inventory data savagely or not good. But now, again, I'm giving a lovely kiss to the housing market for growing inventory. But as mortgage rates have gone below 7%, I've not been able to hit my inventory growth, which is perfectly normal. That's fine. The previous week was negative. And what we're doing is we're getting now toward the seasonality of housing. And again, part of my job is to, again, Sarah, what do I think about YouTube, TikTok, X, Facebook, Instagram? What do I think about housing experts in there?
Yeah, don't have a huge regard for them. Let's say that.
Trash.
Okay,
Absolutely
well, there you
trash.
go.
Have you seen some of this? Oh my God. Like I'm telling you, Saks Realty, holy God. That's like basically Russian propaganda. I literally could take Saks Realty stuff and say that's from Russia and China bashing America and all that stuff. You baby boomers and your love for gold and everything. Lord have mercy. I promise you, when the afterlife comes, there is no gold god waiting for you. There is no gold throne. There's nothing, right? So this whole bashing America because of the Federal Reserve is just no. But one of the things we wanted to teach everyone is how to look at a stressful housing market where we see Americans being stressed and forced to sell. That was always the talking point for the last 12 or 13 years. Americans are broke, they're poor. The dollar's going to collapse. Mexico's going to buy California and Canada's going to buy New York. We're all going to be basically the orc armies in the future. None of that's happened, but there are ways to see that. Right. So my job is, I take it a little bit with a lot of fun, is to point to everyone what to see. And the new listings data is very key in that. And it's in its seasonal decline. It's going to be the second lowest new listings data ever recorded in history. And back in like 2008 to 2012, during that period of times, we were running at 250 to 400,000 per week. Even in a seasonal decline period back then, we were running over 350,000. The last print of the previous week was 59,000. Homeowners are in a good spot. No matter what your YouTube fanatic person says, you cannot bend the laws of math and reality and data for your favor just because you want to bash America. So now we teach this. So if there is stress in the marketplace, you're going to see it in the new listings data. You're going to see inventory start to grow faster, right? But right now, we just don't see that in the data. We haven't seen that data in the data for 13, 14. We haven't seen anything like that since qualified mortgage. See, qualified mortgage changed everything. And because people didn't verse themselves into the 2010 qualified mortgage rule or the 2005 bankruptcy reform laws, they're completely clueless out here. So we're sitting here toward the end. And again, look at the new listings data. When you read that in the tracker, then you look at the inventory, everything starts to make sense. Now, inventory growth slowing down looks perfectly normal. We're going to have a seasonal decline. We got to get ready for 2025. Price growth, again, I was on the lower end of the price growth forecast for 2024, but I'm not a Fed pivot person. Now that rates are going lower, everyone's going to have to read the data going out to the next 12 to 16 months because the dynamics of the rate situation has changed. And
Right.
we've always
Sorry. So that's what I want to get to is like home prices. From your perspective, what does that look like between now and the end of the year?
So it's a seasonal decline of prices that happens every single year. The price growth data should slow. Now, the question is it going to slightly reaccelerate with lower rates if demand picks up? Okay. Now you're always going to have the seasonal decline. So you'll get to see this in the data. I don't see like the existing home sales market like breaking out in demand, but it's just stabilizing. And even now the stabilization, I have a better shot of getting to my 2.3% nominal national. I was not going to be right. I was going to be too low when rates were lower. Now that rates were up, we work off of that dynamics, but the housing market, the national housing market didn't crash, and it's 2024. And if you believe in reading, if you believe in the purity of math, facts, and data, if you're not a fanatic person, right? If you're not crazy, every person on earth can see that in the data lines because there was only one period in time since 1942 that we had home prices crash nationally. And if you're going to use that, you're going to need some similar variable models. This is why I challenge everyone to live debates. I want to absolutely crush you in front of every person on earth. I'm going to ask for your forecasts. I'm going to ask for your models, and I will get nothing because you're all grifters. And I know this. You know this. Some of you made the mistake of debating me. That was the worst part. Okay. We're sitting here just like 2024, homies. Forbearance crash bros, depression, COVID, all that stuff.
Right.
America kicked your, oh my God, it's so beautiful. I love it. I love this country. Awesome
I know
stuff,
you do.
Wheeler.
I know you do. Okay, we're going to end on that very high note. That's great. I'm interested to see what this fall looks like because we have had some more home buying activity in the fall than we would normally think the last couple of years. And to me, that's what we're setting up for here. We're going to have lower rates. People who have been standing on the sidelines waiting. I think we could see some action.
Here's the thing on that: the new home sales market has already had something like that. That was actually a pretty noticeable beat. That was such a big beat in the new home sales report that I'm pretty sure that's going to get revised a little bit down. But the builders data, their forward-looking models are a little bit different than the existing, and it was actually saying that, and that's before this like last move lower in rates. So again, be the detective, not the troll. Read the forward-looking data. If they really start to go positive for the existing home sales, the market has changed. If they don't, it hasn't changed yet. So again, we created the tracker for everyone to keep it simple and go out. And remember, have more faith in the data than a bunch of crazy people on YouTube or X or Facebook or Uncle Dave. Uncle Dave. It's great because there are some TikTok person on Twitter that said, don't buy a house unless you're a millionaire, don't buy a house. Wait till 2008. And I'm sitting there, okay, here we go. Let's go 1942. If you would have listened to that, you never
Right.
bought a home, right? And this is why I always say when people say, Logan, should I buy? I go, hell no. Hell no, you should not buy a home. You're asking me if you should buy. You're not ready. You are not ready. That lady, that man, that family, they're ready. You know why? Because it's just a payment. But if you have to ask another individual, should I buy a home? You're not, it's like when I was a high school basketball coach. Should I go in? No. You have to believe in yourself because it's just a fixed debt payment. You know more than anybody else what your situation is. I don't know who you could be doing some crazy stuff out there. I have no idea what you do with your financials. But how millions and millions and millions of people buy homes every single year. Why? It's just the cost of shelter to your own capacity to own the debt.
Logan, thank you so much for being on today. Thanks for sharing your insights, and we'll talk again soon.
Thank you, Sarah.